Welcome to Market Stalkers Level 2. My name is Diana Angelo and I will be your lecturer for the duration of the course. The second level will be focusing on timing of the trades, both swing and intraday. Even if your goal is to only be a swing trader, you still need to be aware of when is the exact right time to execute that trade. And we base that on the current day's sentiment, which can change day to day. And knowing which side the sentiment lies that day, it will keep you out of supply and demand trades that would otherwise fail if you were only to look at supply and demand zones. There is no better way to read the sentiment than through market profile. One word of advice though, as soon as I say to people that I trade through market profile, they're quick to tell me how profile doesn't work anymore. But I do not use market profile for entries. That's what I have my supply and demand for. I use it for confluence and for intraday sentiment. And also, same people, when we start to talk, very quickly into the conversation, I find out that they've been using the market profile wrong, namely using the full 24 hours profile when they were only supposed to be looking at the active hours of the exchanges themselves. But we'll get to all of that. First things first, let's take a look at the syllabus and exactly what is the Market Stalkers method and how to apply it. Welcome back. In this course, I will cover market profile, as mentioned in the intro. It will have 3 lessons, and I will show you how I use it with supply and demand, as well as looking at some setups. I have very systematic setups with market profile and supply and demand. Then we will go over a typical trading day. In other words, times of day when to trade, because there are specific times of day when high probability setups happen over and over, and there is an underlying reason why that is so. We'll have another lesson on risk management, but this time we're going to go into daily loss limits and daily profit targets for the professional prop traders or the prospective prop traders. We'll also have a look at daily profit targets, pros and cons. Then, if you already work for a prop trading company, I will also talk about how to survive the maximum buying power increase, because a lot of traders get a little bit too greedy and jump the gun way too soon, and their buffer is not quite high enough, and then they get slaughtered, and then they're back on the sim before you know it. So we'll look at how to survive that. I will also go over different capital protection techniques along with the risk management models to make your trading results as consistent as possible, as well as reminding you how quickly your P&L sheet can get ruined through inconsistent positioning. As a part of Level 2, I will also give you the access to psychology lessons for Market Stalkers Level 1, all about mindful trading and developing a trader's mindset. Just in case you either forgot some of those or in case you skipped through the supply and demand course, which is Market Stalkers Level 1, and you immediately went into Market Stalkers Level 2. So as a part of Level 2, you do have the access from the Market Stalkers Level 1 playlist to go and play the psychology lessons. I will also show you one of the setups to look out for through a flowchart that perfectly illustrates the Market Stalkers method. Before we go on, I would like to clarify why I use market profile and not just supply and demand. First of all, here are some of the common supply and demand mistakes. Supply and demand is not really a counter-trend method. Trends are really supposed to be taken from higher time frames, such as 4 hours and daily, and then you're supposed to trade reactions from conterminous lines from those areas and not before. And finally, supply and demand zones have to be located at swing extremes for the swing trades to work. If you are looking at a strong zone that is in the middle of a swing, unless you have another way to gauge market sentiment and to do it with great confidence at that, you won't be able to trade those zones because they are not strong. The position of the supply and demand zone that is outside of the swing extreme is actually a weak zone. So I wanted to clarify that. I keep having people that are coming to me from a very well-known educational company, and the large majority of their tutors, not all tutors, but a vast majority of them, they have managed to perpetuate this idea of supply and demand as some kind of a counter-trend method. And as a result, students who come to me from some of those educators have not only lost ridiculous amounts of money, but they've all done it by having the following three issues in common. They're constantly trying to go against the prevailing trend. They have no systematic way of determining the prevailing trend other than their eyes and going higher highs and lower lows. It's not a good way. And they're also trying to constantly trade the middles of swings without knowing what the market sentiment is on the day. And one of our business partners actually calls this way of trading the middles. He calls it diddling in the middle. And I couldn't agree more. Okay, now I'm going to go through some supply and demand pros and cons, and through market profile pros and cons. So, pros of supply and demand. Supply and demand is one of the most accurate ways to locate a trade entry, okay? These zones also have a very transparent and obvious profit margin that requires no guesswork. You simply read what is on the chart already, and that is always good in trading. Then these zones also have a very clearly defined stop loss and entry without cutting through any candles, okay? You know where your entry goes, which is at the conterminous line, and you know where your stop goes, below the borderline. And also when you're using supply and demand as a trend indicator, just purely as a trend indicator, it gives correct, unambiguous trends simply by looking for breaks of significant supply and demand areas, okay? Cons of supply and demand. It looks like a counter-trend system to most people, okay? The reason why it looks like a counter-trend system is because most people tend to look at only one time frame or very small time frames, like 30 minutes and 5 minutes, or 15 minutes and 5 minutes, or any combination of those. Even hourly charts, they will not give you the information on what the medium trend actually is. So because you're looking at a particular move up without knowing what is going on the higher time frames or medium time frames, i.e. seeing the forest for the trees, you won't know where exactly you are. So a lot of people think that what we're doing, we're going against the prevailing trend, but that's not true. We're going with the trend, shorting pullbacks into the larger time frame areas. Okay, so it's not a counter trend. The next step where supply and demand fails is that it provides absolutely no information on intraday sentiment in relation to previous trading day. You have no way of gauging that. Also, supply and demand strength levels do not work if they're in wrong areas, like in the middle of swings. So because of all of this, when I first started with my own intraday trading and my own career, I found myself very humbled, because at that time I was already a very successful swing trader, and I've done incredibly well for myself, and yet at my very first prop trading job I didn't actually last long, and it was all intraday, it was all daily settlement, and I failed. There was no way that I could make supply and demand work on high accuracy as well as I was making it work on a swing. So ultimately I ended up using stops that were way too large, and while I had some amazing days, I also had a lot of days where I got completely slaughtered. And that's when I realized that I needed to find another way to read the sentiment day to day. I felt that there was something missing from the whole picture. When I started to work for my current prop trading company, I ran into market profile. Now I knew about market profile and I knew what it was, but I couldn't really find anyone to explain it to me until I ran into my risk manager, who's still my mentor and my risk manager. And he taught me how to use market profile, okay? Once he's taught me how to use market profile, I was then able to marry that system with my own already existing supply and demand system, and it created a very high accuracy, high risk reward, monstrous system. And with market profile, a lot of people are quick to tell you how market profile used to work in the 80s and it's an outdated 80s technique that doesn't work anymore. But I will tell you right now, like I said at the beginning, I use market profile for sentiment and not just for my entries. For my entries, I use Q points first and foremost, followed by supply and demand, and price action on lower time frames for intradays. And then I also look for a confluence of something from the market profile concept that is called the value area. I mainly trade from consolidations and reactions from lower time frames, and I always heavily rely on the profile for timing of my swing trades. I don't really need strong supply and demand zones in order to execute my trades. All I need is a conterminous line that matches the sentiment for the day. Okay? So it's a very different way to just trading SAM-side and supply and demand. You know, this is not like, while the supply and demand obviously has a lot of common points the way I do it with Sam Seiden's method, I have completely changed it to mainly use Q points. So supply and demand to me is more like a very loose crutch that I use for trade entries, but nothing else. However, when the strong zones do come up, it is very important to know that that is a strong zone and to recognize it, especially when you're at extremes of swings. Okay, market profile pros and cons. So pros, it is the only tool that I've come across that can systematically determine the correct changes in sentiment day in, day out. It can also provide the information on who is making the moves. Is it the market makers, concerned with only filling the volumes of their trades and getting commissions on them? Or is it that hedge funds and central banks who are actually positioning themselves for longer term trades as a part of their asset allocation methods? It's a very different way of trading, okay? And then it also gives the only low risk technique on getting back in on a trend that has already started from an SD zone, which supply and demand frankly completely fails at. And usually the stop required for me getting back in on those trades is really tiny, okay? Market profile cons. Entries that are taking purely off market profile are late entries when you compare them to existing supply and demand zones in the same area. The second thing that is not good about market profile is that back in the 80s you used to be able to do a Wall Street open plays, but they are no longer valid. And this is not because market profile doesn't work, it's simply because of the difference in the liquidity that's present in the markets today. We have a lot less money in the markets, even with the stock market that quadrupled. But when you look at the average daily ranges now and average daily ranges in the 80s, they are incomparable. Like 80s had masses of average daily range to work with. Now we have tight ranges, and you have to be a really good trader in order to make this work. So sadly, the plays from the Wall Street Open, from the profile, they're no longer valid. And finally, what I find not useful with market profile, again, you might be different, but it's never really helped me because I'm able to see the markets from a top-down approach and I see everything already, the destinations of the trades, the swing extremes, and I know where the price is going. For me, the hindsight analysis of the previous day's profile composition, it really provides very little value for the following day. Just because you had a buying tail yesterday, it doesn't mean that today the markets are going to keep going in the same direction. You have to see where it is in Q points. You have to see what's around. Is it hitting a supply? So just by seeing and recognizing that there was a buying tail there, it does not translate into those same aggressive initiative buyers that stepped in yesterday. It doesn't mean that they're going to step in today as well. So for me, I have other ways to look at what is going on behind the scenes, so to speak. So, what is the Marcus Stalker's method? The first part is to determine the trend through supply and demand as a trend indicator by seeing which zones are significant enough to signal the trend change. Until those zones are broken, trend remains. It doesn't matter how far away it is. All it is, if you have nothing from, like, let's say, this level to that level and we're kind of trading through it, just because you might have an H1 zone somewhere in the middle, that is not a significant thing enough to change the trend. So that should be looked at as a pullback into the zone. If you cannot remember what makes a zone significant, please go back to Marcus Stalker's level 1 and revise lesson number 9, supply and demand as a trend indicator. 2 out of 3 time frames need to match. So if you're looking at M30, H4 and D1, ideally H4 and D1 should match trend. If they don't, you then go up to weekly and then you use daily and weekly to see what the trend is. So always trading off the medium and slightly higher time frames. If you're looking at trading off a 4-hour chart, ideally 4-hour and daily should match, or daily and weekly should match. 2 out of 3. If things are mixed, like if you have an H4 down, daily up, weekly down, then you have to use market profile to actually determine sentiment on the day, because that means it's not just enough to have H4 down and then skip a time frame and then go weekly is down too. That's down. You need to have adjacent time frames matching trend. Okay, so rather than relying on H4 prevailing trend, take the higher one and then see whether the profile matches it. Step 2. Step 2 involves stuff that we learned in Marcus Stalker's level 1 about the extremes of swings and my Q points, the quartile points that help us with locations of the zones that have the most probability of working out. So we first determine the price location in relation to Q points. Then we examine the price action on larger time frames, starting from daily, to see if the price has rejected Q highs or Q lows, because what frequently happens is that supply and demand zones are too high up, but there's a Q point underneath it, and then you can look at a Q point as a reactive key level. For example, if I show you the USD CAD chart on a monthly, if we go back to see where this thing came from, I'm just modifying my Fib tool to display the Q points, because on this platform I don't actually have enough history there. Okay, so this is the Q point, and this is exactly what I'm talking about. So here we have a strong supply, but it's too high up. However, now on a monthly chart we've had a reaction from a monthly Q point, from a quartile high. We have printed a reversal hammer. And now price is also attempting to create a bearish engulfing, and that won't be valid until the monthly candle ends. Should you have a bearish engulfing that is 100% confirmed rejection pattern from a Q point, not from a supply and demand zone. All right? So Q points are the missing link to supply and demand. And remember where you heard about Q points first, from me. They are my creation. Step 3. Market profile value area. Well, look at what it is and you will get very familiar with the value area. But you first need to find the value area from yesterday's trading, either manually, and I do have a free guide on how to get sort of an okay calculation of the value area, or if you don't want to waste time doing that, or you have too many things that you're looking at, you can always use our Blatek market profile indicator, which is available from MQL5.com marketplace. If you wish to do that, use the main navigation menu from the top, and under products there will be a page with the link to the indicator. Once you have the value area calculated, you can determine the intraday sentiment based on the current session's value area. So if you're trading London, and please bear with me here, I know that I'm throwing terminology at you, but I'm just telling you what the system is. And as we go through the lessons, everything will become clear. So you're looking at a value area, and whichever session you're in, that is the value area that you will be referring to from the previous trading day. So if you're trading London session, you'll be comparing it to the London session from 24 hours ago. If you're using New York session, then you'll be comparing that to the 24 hours from New York session. So what are you doing with the value area? You're comparing Wall Street Open, for example, 24 hours ago with today's open, and then seeing where you are in relation to that. It is a vastly simplified explanation of what value area does, but I will go deep into that subject in the market profile videos, okay? So everything will be clear. I go very slowly so that everyone can really understand. And it's not that difficult, it's just that there's a lot of new terminology that you need to get familiar with. And finally, the fourth step is to find conterminous lines of supply and demand areas, or bullish and bearish engulfings. So locating nearest stage 4 daily and weekly conterminous lines, and finding confluences with the value area and trading reactions from those areas from lower time frames, such as M30 or M15 or H1. Okay, so now you have an idea of what we're going to be doing and learning in Market Stalker's intermediate level. So get ready for lesson number 2.